Welcome back to our short videos of important topics. This one is about preferred stock. You will find some companies are structured with preferred stock and some with only common stock. A corporation can issue two basic kinds of stock, common and preferred. Preferred stock is a separate class of stock that typically has priority over common stock in dividend distributions and distributions of assets in a liquidation. Preferred stock usually has a stated dividend rate that is expressed as a percentage of its par value or as a dollar amount per share. It normally does not have voting rights. Now, corporations may issue preferred stock to be able to raise needed capital without sacrificing control, since preferred stock has no voting rights. Issuing preferred stock is a way to increase the return to common shareholders. It is also a way to increase ownership in the company if the common stock is perceived as too risky or has a lower than expected return. Recording preferred stock is very similar to recording common stock, we just use different account names. It is important to understand if the preferred stock is cumulative or non-cumulative. Cumulative preferred stockholders have the right to be paid both the current and all prior period unpaid dividends before any dividends are paid to common stockholders. When preferred stock is cumulative and the directors do not declare a dividend to preferred stockholders, the unpaid dividend is called a dividend in arrears and must be disclosed in the financial statements. Non-cumulative preferred stock has no rights to prior period unpaid dividends if they were not declared in prior periods. A preference for dividends does not ensure dividends. If the directors do not declare a dividend, neither the preferred nor the common stockholders will receive one. To illustrate the difference between cumulative and non-cumulative preferred stock, assume that a corporation's outstanding stock includes 1,000 shares of $100 par, 9% preferred stock, yielding $9,000 per year. That's 1,000 shares times 100 times 9% in potential dividends, and 4,000 shares of $50 par value common stock. During 2014, the first year of operations, the directors declare cash dividends of $5,000. In year 2015, they declare cash dividends of $42,000. Whenever dividends are declared by the board of directors, preferred shareholders are entitled to receive a 9% dividend rate on the par value of their shares. This equals 9% times $100 per share or $9 per share. Since 1,000 shares are outstanding, the preferred shareholders are entitled to receive $9,000 before any dividends are paid to common shareholders. As you would expect, the preferred shareholders receive 100% of the $5,000 dividends paid in 2014. Now, allocation of the year 2015 dividends depends on whether the preferred stock is non-cumulative or cumulative. If the preferred stock is non-cumulative, these stockholders have no rights to the missed dividends of the year 2014. However, they get the first distribution of dividends declared in 2015. Since $42,000 in dividends were declared, preferred stockholders would get their $9,000 first, and the remaining $33,000 would be divided among the common stockholders based on their ownership percentage. Now, if the preferred stock is cumulative, it's a different story. These stockholders have rights to the missed dividends in 2014 in addition to the dividend in 2015. In 2015, the preferred stockholders first get a distribution of $4,000 for the missed dividends of 2014. Then they get another $9,000 for the dividend in 2015. Since $42,000 in dividends were declared in total in 2015, after the preferred shareholders are paid their $13,000, the remaining $29,000 would be divided among the common stockholders based on their ownership percentage. Now you can see the distinction between cumulative and non-cumulative classes makes a difference to stockholders. If this sounds confusing, there's a homework example so you can see how the numbers work out. This concludes our discussion about preferred stock.